Welcome to the Deep Dive. We take your sources, we dig in, and we find the core insights for you.
And today, we're looking at a pretty specific one, the examiner's report for the ACCA financial management exam. The FM paper, December 2024 sitting.
Exactly. And this kind of report, it's gold, isn't it? It's straight from the examiner.
It really is. Gives you that direct line of sight into what candidates did well, and maybe more importantly, where they tripped up consistently.
Right. So our mission here is to pull out those key observations on how students performed. Think of it as like a shortcut to understanding the real challenges, the successes in this specific finance exam.
We're talking common strengths, those recurring weaknesses, and critically, the advice the examiner gives for next time.
Getting inside the examiner's head, basically, which is, well, pretty invaluable if you're tackling this stuff.
Couldn't agree more.
Okay, let's unpack it then. Starting with Section A, the objective test questions. The report actually flags 4 specific ones here that seemed particularly difficult for candidates.
Right. Yeah, the first one they mentioned was example 1. It involved a company called Snowco.
Okay.
And it was testing the calculation of the market value of a redeemable loan note. The answer should have been $102.93.
$102.93.
$102.93. So what went wrong? What were the common slip-ups?
Well, the report points to a couple of main things. Quite a few candidates seem to ignore the redemption premium altogether.
Oh, right. Which is pretty fundamental for redeemable debt.
Exactly. Or the other big one, they used a post-tax coupon rate in the calculation.
But the coupon payments, those are usually pre-tax cash flows in this kind of valuation, aren't they?
Precisely. So getting that tax treatment wrong or missing the premium, it just completely, throws the whole calculation out, really highlights how you need to apply that formula carefully.
So it's not just knowing the formula exists, but actually plugging in all the right components correctly.
Got it.
What was the next tricky one?
Okay, example 2. This one moved away from calculation, more towards understanding. It was about money market instruments.
The question basically asked which instruments on a list were not found on money markets.
And the answer was?
Preference shares and irredeemable loan notes.
Yeah.
And the key thing here, the report points out, is these are long-term instruments.
Whereas money markets are all about the short-term, high-liquidity stuff, like treasury bills, commercial paper.
Exactly. So this was testing that core conceptual difference between the markets. Not complex maths, just do you know what belongs where?
A basic knowledge check, but clearly one that caught people out.
Yeah, seems so. Next up, example 3. This brought us back to calculations, Sunny Peaks Co., and finding the cost of equity using the dividend growth model.
Dividend growth model. Okay, DGM, the answer was 19%.
19%, yeah. And the errors here, again, show issues with applying the model properly. A really common one was not applying the growth rate to the current dividend.
To get D1, the next year's expected dividend.
Precisely. You need D1 in the formula, not D0. And others apparently struggled with just rearranging the formula. The standard DVM formula to solve for the required rate of return, the cost of equity.
So a bit of algebra trouble mixed with getting the right starting dividend figure.
Seems like it. Knowing the formula is one thing, accurately using it, maybe rearranging it under pressure, that's the challenge.
Okay. And the last one for Section A.
Example 4. This was about the role of financial intermediaries. Specifically, who would a company, Istrom Co., go to for advice on raising a large amount of capital? $150 million.
And the best bet, according to the report, was an investment bank.
Correct. Yeah, the report stressed that the other options listed things like discount houses, unit trusts, even clearing banks. They're financial intermediaries, sure, but they don't typically offer that kind of large-scale corporate finance advice on capital raising.
So it's about knowing the specific function of each type of institution.
Exactly. Understanding who does what in the financial system.
Okay, that paints a pretty clear picture for Section A. Some calculation precision needed, some core concepts. Let's shift gears then and dive deeper into Section B. These were the objective test questions, but based on case studies.
Yeah, Section B. And the case study focused on here involved Griffco. They had some foreign currency legal expenses, so naturally, risk management came into play.
Makes sense. Okay, question 1 in that Griffco case, exchange rate theory.
It asked what could explain why the peso per dollar forward exchange rate was lower than the spot rate.
Okay, so the forward rate was at a discount. What's the theory say?
Well, Based on interest rate parity theory, the idea that interest rate differences drive the difference between spot and forward rates, the correct explanation was that the peso interest rate must be lower than the dollar interest rate.
Right. Lower interest rate currency tends to trade at a forward discount.
Exactly. It's a cornerstone of international finance theory. So they were testing that understanding.
Got it. What about question 2? Forecasting exchange rates?
Not actually doing forecasts, but understanding the theories behind forecasting.
Oh, okay.
The report says only one statement given was correct. And that was, under purchasing power parity, changes in domestic inflation rates are balanced in the longer term by changes in exchange rates.
PP, the idea that exchange rates should adjust so stuff costs the same everywhere, eventually.
Pretty much, yeah. And the report also made a point of clarifying something about the international Fisher effect, that it relates to nominal interest rates, not real rates. That was apparently relevant to one of the wrong answers.
Okay, so nailing the core idea of PPC and the specifics of IFE. Now, question 3. This sounds interesting. A calculation.
Yes. Calculating a cost saving.
Yeah.
For Griffco, if they made a lead payment paid early instead of using a 6-month forward contract to hedge.
Comparing 2 hedging strategies, and the saving was?
The correct saving was $97,896. But here's the kicker, the most common error, according to the report.
Cool.
Candidates used the exchange rates for selling pesos when they should have used the rates for buying pesos.
Wow. Seriously, just mixing up the buy-sell columns on the rate sheet.
Exactly. It just completely tanks the calculation. It really hammers home how vital that sort of granular attention to detail is, especially under exam pressure. It wasn't necessarily a failure to grasp hedging concepts.
Just applying the wrong number.
Precisely. A really powerful lesson there.
Definitely. Okay, what about question 4, interest rate risk?
Yeah, and on this one, the report says neither statement provided was correct.
Oh, okay. A bit trickier then.
It was testing 2 specific concepts. First, it clarified that a negative gap exposure means your interest-sensitive liabilities are greater than your interest-sensitive assets, not the other way around.
Right, the mismatch between assets and liabilities repricing.
And the second concept was basis risk. The report defined it as involving variable rates that are determined on different bases, like maybe one loan is tied to LIBOR, another to base rate. Even though both are variable, they don't move perfectly together.
So again, testing very specific definitions and implications, not just a vague idea of risk.
Exactly. And then the last one for section B, question 5, was about interest rate derivatives.
Things like swaps, futures.
Yep. The report highlighted the correct statement was one describing a simple interest rate swap, exchanging fixed and variable interest in the same currency, saying it should benefit both parties involved.
Makes sense. That's the point of a swap.
Right. And it implied the other options, maybe about futures or callers or OTC options, had incorrect descriptions or implications in the question. So fundamental understanding of how a basic swap works was key.
All right. That gives us a really good feel for sections A and B. Precision, core concepts, reading the question carefully, using the right data seems to be the theme.
Absolutely.
Now for the big one, section C, the constructed response questions, where you actually have to write things out, show your calculations.
Yeah, section C is where candidates really show their deeper understanding, or, well, where the gaps become clearer. The report goes into detail on 2 questions here. Gallico on investment appraisal and Guillermo Co. on working capital management.
Let's take Gallico first. Investment appraisal. Requirement A was calculate the expected NPV and comment on financial acceptability. That sounds like a classic. 12 marks in total.
Yep, 10 for the calculation, 2 for the comment. And it was comprehensive. Tested NPV, obviously, but also inflation, tax, how to handle risk. A really crucial first step, the report stresses, was getting the expected sales volume right for years 2 to 4.
Expected volume, so there was uncertainty involved.
Yes. The report says the correct expected volume was 8,500 units, but you had to calculate that.
Oh.
Using the probabilities given in the scenario. There was a 30% chance sales would drop to 5,000 units and a 70% chance they'd stay at 10,000 units.
What's that? So weighted average calculation,
Yeah.
0.3, 5,000 plus 2.7, 10,000.
Like a 1,500 plus 7,000 gives you 8,500. But getting that initial figure wrong, well, it cascades through the whole MPV calculation.
I bet. A common mistake then.
Seems so. And beyond that, applying inflation correctly, cumulative inflation, year on year, to sales price and variable costs. That was another hurdle. The report listed widespread errors here.
Right. What?
Well, apart from the wrong sales volume,
Right.
miscalculating the tax benefit from depreciation, the tax shield, getting the timing of the tax payments wrong, errors in working capital, calculating the investment needed and then the recovery at the end. It tested pretty much every core element of a realistic NPV.
Sounds tough. And the 2 marks for commenting on financial acceptability.
Yeah, it wasn't enough just to say, oh, the expected NPV is positive, so accept. Stronger answers, the report says, linked it back to that expected nature, acknowledging it's based on probabilities and the actual outcome could be better or worse if sales hit 10,000 or only 5,000.
So interpreting the number in context.
Exactly. And they also mentioned using spreadsheet functions correctly, like the NPV formula, helped.
Makes sense. Okay, what about Part B of Griffco?
Part B, switch to risk management theory. Discuss 4 techniques for dealing with risk and uncertainty in investment appraisal. 8 marks, so 2 per technique.
2 marks each. That suggests you need more than just a name or a 1-sentence definition, right?
Definitely. The report was really clear on this. Just listing, say, sensitivity analysis, probability analysis, simulation, whatever, that wasn't enough.
So what were they looking for?
Depth. Applying the technique to the Griffco scenario where possible, and crucially, discussing a technique's limitations or implications.
Ah, okay. Like for probability analysis.
Yeah, maybe discussing how hard it is to get accurate probabilities in real life.
Yeah.
Or for sensitivity analysis, pointing out it usually only changes one variable at a time and doesn't tell you how likely that change is.
So showing you understand the pros and cons, the practicalities, not just the textbook definition.
Precisely. Generic answers didn't cut it.
Okay, that covers Griffco thoroughly. Let's move to the other big Section C question, Griffco, focusing on working capital management.
Right. Griffco. This one covered ratios, the cash operating cycle, and even a specific cash management model, the Miller-Orr model.
Okay, requirement A was calculating the cash operating cycle. 5 marks. What did people go wrong here?
Again, it came down to precision with the input data for the ratios. Really common errors included using cost of sales from the income statement to calculate raw material holding days.
Instead of using raw material purchase.
Exactly, which is usually the more appropriate figure. Also, sometimes not calculating the holding periods for each type of inventory raw materials, WIP, finished goods separately, if the data allowed. And for receivables days, using total revenue instead of credit sales. If the scenario gives you credit sales, you should use it. It's more accurate for debtor collection periods.
So again, it's about knowing exactly which number fits into each part of the ratio formula. Shows you understand what it's measuring.
Absolutely vital. Then, requirement B, 6 marks, ask for 3 ways Griffco could reduce its cash operating cycle using info from the scenario.
Linking suggestions to the specific company.
Yes, detail was needed. So if the scenario hinted at, say, Guillermo holding way too much raw material inventory,
You'd suggest something like just-in-time purchasing.
Exactly. And explain why that helps Guillermo specifically. Generic suggestions like collect debts faster without linking to a problem identified in the case wouldn't score the full 2 marks per point.
Application, application, application. Got it. What about requirement? C, the Miller-Orr model.
Yep. Calculate the target cash balance using Miller-Orr. Only 3 marks, but testing a specific technique.
These models can be tricky. What were the key steps and errors?
Key steps are, first, figure out the daily variance of cash flows, not standard deviation. Second, calculate the daily interest rate, not annual.
Common conversion errors there, I bet.
You bet. Using the annual interest rate or using standard deviation instead of variance in the formula for the spread, that was where people typically went wrong, according to the report. Those inputs are crucial for the model to work.
So follow the steps, use the exact right inputs. Even a small mistake throws the whole thing off.
Completely. And finally, requirement D, 6 marks, asked candidates to discuss the motives for a business to hold cash.
The classic 3, transaction precautionary speculative.
Those are the ones. But again, for 2 marks per motive, just naming them wasn't enough. You needed depth.
Like giving examples.
Yeah, or explaining the consequences of not having enough cash for each motive, showing a deeper understanding of why cash is held beyond just listing the textbook terms.
Okay. So looking back at this whole report, sections A, B, and C, what are the big takeaways? What does this tell us about succeeding in this FM exam?
Well, a few things really stand out. First, meticulous, careful application of formulas and techniques, it's just non-negotiable. Getting the right numbers, handling inflation, tax, exchange rates correctly.
Precision matters.
A lot, hugely. Second, understanding the underlying theory is essential, but you have to be able to connect it to the specifics of the scenario you're given.
Right, especially in Section C. You can't just talk in generalities.
No. You need depth in your discussions. Apply the concepts, discuss limitations, use the case details. That's where the higher marks are. The report clearly shows where candidates fell down on basics like calculating expected values, or identifying the roles of intermediaries, or using the right data in ratios.
So understanding these common pitfalls like the buy-sell rates, annual versus daily interest, cost of sales versus purchases, it gives you a really powerful insight into where to focus your own learning, doesn't it?
It's basically a roadmap of things to watch out for. This report, specifically, gives fantastic guidance on areas to really nail down and mistakes to consciously avoid. It shows that knowing what a formula is step one. Applying it accurately and explaining why. That's mastery.
Absolutely. So here's something for you, the listener, to think about as we wrap up this deep dive. How can really digging into the mistakes others have made, like we've done with this examiner's report, actually change how you learn? Not just for finance exams, but for any complex subject or skill. Does seeing where others stumble help you build a better learning strategy for yourself? Something to chew on.